Should you consider investing your hard-earned money into a hedge fund? How hedge funds work? Do they actually outperform the markets on a consistent basis, or it's a complete waste of time and money? Those are the questions I'm gonna answer in this video. So welcome, my friend. My name is Vitaliy Dubinin, founder of Financial Freedom Academy. And of course, hedge funds are one of the thousands of different investment options that you can put your money into. So what is a hedge fund? A hedge fund is a private investment vehicle that is very exclusive. There is lightly regulated, and they can actually do whatever it is that they want. They can invest in whatever they want. They do not have to disclose what they buy, when they sell. So there is a lack of public reporting. And in order to invest into a hedge fund, you need to be what's called an accredited investor, meaning you need to be rich and have an assets of at least $1 million that is outside of your home residence, or you need to earn at least $250,000 a year. There are currently about 10,000 hedge funds in the world that are overseeing over $5 trillion in assets. But here is the kicker. Actually, the majority of the hedge funds do not outperform a single S&P 500 index. When you see the 500 of the top US companies, for example, you buy an ETF of that, it doesn't outperform it. So why do wealthy people put their money into a vehicle that is actually does not outperform the market, at least consistently and the majority of the time? Well, if you look at it, the hedge fund provides you different options that they can invest in different things that the public cannot invest. Distressed companies they can buy. They can go into some private loans, some private real estate deals. They can bet on interest rates on another country or short down the entire economies. They can take on more risks that the mutual fund managers or they can just simply cannot afford to take. They can take on leverage, they can play with options and derivatives and all kinds of strategies. And they do not disclose exactly to the public what it is that they are doing. They are not give public reporting, they're not give you the safety and protection, and you cannot just pull the money out of the hedge fund whenever you want, because it needs to play out their strategy. It put on risk other people who are in the hedge fund. So typically you cannot just pull your money out. You need to wait for 6 months, 1 year, 2 years, and you pay a very hefty fee. You actually pay 2% a year management fee to the fund manager, 2% a year fee, and 20% typically you'll pay what's called a performance fee. Now, this is absolutely insane. You are taking all the risk. The fund manager, right, basically collects the money from a whole bunch of wealthy people, and whether he is performing well, whether he's making money or not making money, he's always gets paid 2% a year management fee. So if it's a $1 billion hedge fund, there is a $20 million pay regardless of if he makes money or not, okay? So that's something to keep in mind. The fees are outrageous for the hedge fund. And why there is lack of protection? Because the government thinks, okay, if you have at least $1 million, if you are wealthy, well, you don't need as much protection because you can afford to lose your money. You see, after the 1929 crash in the US economy crash, 90% stock crash, the Great Depression, there was a 1934 act of the Security Exchange Commission was born to make sure the markets are safe to trade, they're fair, and the companies are disclosing their earnings and what it is that they are doing, okay? So with a hedge fund, there is no such thing as full disclosure. So why still the wealthy do it and they invest money in the hedge funds? Well, mostly it's because to be in the club. I am I'm in the inner circle. I'm in this club. I belong to this group of people who are investing in these hedge funds. It opens some doors, some connections that are strategic, and it gives some asymmetric bets, right? What is an asymmetric bet? If you risk $1 to get $10, right? So those are not some typical investments the general public have access to. So they're hunting for those deals that are not available to the public, but still the risk is too high. My verdict, okay, because the risk is high, there is no disclosure, you need to risk a whole bunch of money, and it doesn't outperform the market. For the most people, 99% of the people just go with the index funds, just go with the ETFs. Of buying a broad spectrum of the market is accessible to everyone, and you pay a fraction of a fee, maybe 0.3% or 0.1%, but not such high management fees. Okay, so I hope that it sheds some light into the hedge funds. If you hear this word hedge fund thrown around, you have more understanding about it, and you will know how to deal with the subject. Okay, it's been Vitaliy Dubinin. I hope you enjoyed this video. Join Financial Freedom Academy to learn the strategies of how to manage your money well, how to grow your money, what are different ways that you can do to become more financially free. I'll see you on the inside. Thanks for watching.